Welcome back to Finance Uncut. On today's episode, gold, silver, and huge returns.
John Paulson made Wall Street's most lucrative trade of all time.
One of our investors called me and he said, John, I just got the monthly results. I think there was a mistake.
It was no mistake. Paulson's bet on the collapse of subprime mortgages in 2007 earned his firm $15 billion, the largest one-year payout in the history of financial markets.
It's kind of like finding a needle in a haystack.
Paulson's 2007 performance rocketed him to the ranks of superstar managers. At its peak, his firm managed $38 billion, making it one of the largest hedge funds in the world.
It opened up a lot of doors and became very interested in terms of the people that I met.
Paulson has yet to repeat the success that made his fortune. Recently, he joined a list of industry legends to quit the hedge fund business, converting his fund into a family office.
Personally, I never really liked the business side of the business. I did like the investing side.
He's also enjoyed giving away his fortune. He pledged $400 million to Harvard University and donated $100 million to the Central Park Conservancy.
I wanted to give back to the institutions generally that were important to me.
John, you made one of the most famous investments in Wall Street history. Over a period of time, you put a short on, in effect, to make it simple, on the mortgage market around 2007 or so. And that trade, it is reported, made roughly $20 billion or so for you and your investors. Nobody has reported anything more profitable than that in the Wall Street, I'd say, last couple of decades or so in one trade. Did you have any doubt that that trade was going to work?
Well, we were pretty convinced that the mortgage market, segments of the mortgage market were overvalued and were likely to implode. So we took a very concentrated position in these securities, and what we expected to happen happened.
It can't be that easy because nobody else quite did what you did. So at the time that you were doing it, did you have any sleepless nights saying, hey, I might be wrong and maybe I'll lose a lot of money, or you didn't really worry about that so much?
Well, again, it was structured where the downside was very limited. I think the reason why other people hadn't done it is because there had never been, according to Moody's and S&P, a default of an investment-grade mortgage-backed securities. Mortgage-backed securities were viewed as the safest securities next to treasuries. And that was essentially true up until that point. What they missed was the underwriting quality had never been as poor of securities as it had been in that period. So the fact that they hadn't defaulted in the past had nothing to do with whether or not the securities that were being issued would default in the future.
The idea for doing this, was this something that came to you one day when just reading the newspapers or watching Bloomberg on TV, or did somebody who worked for you come with this idea? Where did the idea come from?
I developed a specialty, which very few people do, in shorting credit. The difficulty in shorting credit is you have to get a borrow. They're generally illiquid, so you can never get size. But I never gave up on looking, and finally we found it in the mortgage-backed securities market, which at the time was larger than the treasury market. So there was literally unlimited liquidity. And because of the development of the credit default swap market, you didn't have to get a borrow. So there was synthetic securities, just people trading synthetically on actual bonds. And you can do 100 million. We were doing 100 million on a clip, 500 million a day with banks, in some cases $1 billion a day with banks. So there was massive liquidity to set up these positions.
So when you did your famous trade, you became world famous. Before, you were relatively unknown to the public. How did that change your life? All of a sudden, people are calling you all the time. High school friends are saying they always knew you were going to be successful, and they're calling you for contributions or whatever else. How did your life change?
Well, it was very funny. I remember the time that it happened, David. One of our investors called me. He said, John, I just got the monthly results. I think there was a mistake. It said 66%. You meant 6.6%. And I said, no, it was 66%. He goes, well, that's impossible. I've invested with Soros, with Tudor Jones, with with everyone. No one's been up 66% in a year. How can you be up 66 in a month? I said, well, that's what happened. Shortly after that, all our investors got these results, and it leaked out to the press, and then became, the cover story in the Wall Street Journal, which was picked up globally, that we had this incredible performance in February, up 66% net. And that performance continued throughout the year. The funds wound up being up close to 800% net for the year. And, opened up a lot of doors and became very interested in terms of the people that I met.
It was reported in the press that you had to write a check at one point to the federal government, IRS, of over $1 billion. Does it feel nice to write a check over $1 billion, or is it a little bit painful to the IRS?
Well, we were big supporters of not only the U.S. Treasury, but also New York State and New York City. So we paid, a fair amount of taxes.
So you don't have in your office anywhere a check that says $1 billion plus to the U.S. government? You don't keep that check?
Yeah, I don't keep the check, but I do keep the tax returns, both the state tax returns and the federal returns.
So I've asked you from time to time outside of this setting, when I've seen you, do you have any other good ideas like that one? And you've always said to me pretty much what you just said. If you have something good, you would let me know perhaps, but you haven't anything as good as that. Is that right? You haven't anything as good as that yet?
I would say not as good, but I would say the area that's most mispriced today is credit, and the potential. I think the 10-year Treasury is about 1.3%, and the 30-year Treasury bond is 2%. And we're coming into an inflationary period. I think the PPE came out today and it was over 7%. The CPI came out yesterday, it was over 5.5%. So you have inflation, current inflation, well in excess of long-term yields. Now there's a perception in the market that this inflation is transitory. I think they bought the Fed line that it's just temporary due to the restart of the economy, and it's eventually going to subside. However, if it doesn't subside, or if subsides at a level that's above the 2% that the Fed is targeting, or stays in the 4%, 3 to 5% range, then I think ultimately interest rates will catch up and bonds will fall. In that scenario, there are various option strategies related to bonds and interest rates that could offer very high returns if interest rates do move up to those higher levels.
Stagflation threatens to upend the global economy. And in this chart from top-down charts, you can see that the inflation surprise index is going up, while US economic surprise index is going down. Literally the definition of stagflation. And JP Morgan, global food price jump may herald persistent inflation gains. And from the largest food group in the world, Nestle sees higher input costs inflation next year. The article says that Nestle expects even higher input cost inflation in 2022 than this year, the world's biggest food group's chief financial officer said on Thursday. If we talk of 2022, it is likely that input cost inflation will be higher next year than this year. Wow. Our strategy is to offset anything we receive through pricing. The idea is to pass it on to the trade and to consumers whenever we receive it, he said. Well, there you go. We've already got high inflation, high food inflation, and we're told by the world's biggest food group to expect higher inflation that will be passed on next year. And inflation could spark new global financial crisis, says Russia's central bank. Russia's central bank says a new financial crisis on the scale of the 2008 collapse could happen in less than 18 months if global inflation is not kept in check. Now, let's cut back to a clip from John Paulson on how he's playing this.
When you've had a kind of a life-changing event or an unbelievable success, as you did with that trade, is there a temptation to say, I don't want to tempt fate and try it again? Or you want to prove that you can do it again and you're looking for another deal just as good as that one?
We do look, but you have to be realistic. We have put on some trades that, on smaller scale that have potential returns of 25 to 50 to 1. related to both interest rates and gold prices. So, our viewpoint is that the markets are currently too complacent regarding inflation, and that if inflation does prove to be higher than expectations, that will result in both higher gold prices and higher interest rates. And if you get those two happening at the same time, in a period of time, we can set up positions that could, return from 25 to 50 to 1.
Now, after you made your famous trade that we talked about, I think you put on a trade where you bought a lot of gold or gold futures, and you were what was called by some a gold bug. You're a big believer in gold. Gold's now about $1,700 an ounce or so. Are you believing that gold is now a good investment at this price?
Yeah, we do, and thank you for bringing that up. We do believe that gold does very well in times of inflation. So what happens is if you own long-term treasury bonds that are yielding 2% and interest rates move up to 5%, those bonds fall materially in value. Likewise, if you have cash sitting in a bank that you're earning 0% on, inflation's 4%, you're gradually eroding the value of your money. So as inflation picks up, people try and get out of fixed income, they try and get out of cash, and the logical place to go is gold, especially if it starts to rise in inflationary times. But because the amount of money trying to move out of cash and fixed income dwarfs the amount of investable gold, that the supply and demand imbalance causes gold to rise. And the more it rises, it sort of feeds on itself and has the potential to go what I call parabolic.
So John thinks gold is going to go parabolic. Well, does he think it's going to go parabolic like the value of one gold mark in paper marks in Weimar, Germany? Well, what's interesting about this chart is if you have a look at the middle of 2019 right through towards the second half of 1921, you can see that the mark actually grew in value against gold. And then it was late 2021 where, the value of the currency started to go down, or gold started to go up. But then it came back down again. So from 21 through to, the beginning of 2022, once again, the value of the mark over gold came back. And then it wasn't until, early to mid 22 that the value of the paper mark was severely devalued, and we saw gold valued in those marks rise significantly. And then obviously 1923, we know what happens there. And it's interesting that people like Professor Richard Werner, Dr. Michael Burry, and many others now are now calling for hyperinflation. Even some people who were deflationists are now saying we're headed for at least the 1970s style inflation. But the hyperinflation thing that Michael Burry talks about is quite interesting. And Professor Richard Werner actually said to me, 1923 will be 2023. And so the parallels here are quite interesting, that, gold hasn't necessarily done so well just yet. And that's key statement, is just yet. So is this the type of parabolic move that John's talking about? M1 money stock and gold. Well, we know that the M1 money stock has been discontinued. And there we go. It's been discontinued. And also GDP is now being discontinued. Hiding a lot of data there. Why? You got to think, why are they hiding so much data? So for my Basel III video, I was doing a bit of reading and homework on what the World Economic Forum had to say about gold, or any links there. And I found two interesting articles that I wanted to share. This is why we use gold as currency, so why gold is money. Gold does not dissipate into the atmosphere, it does not burst into flames, and it does not poison or irradiate the holder. It is rare enough to make it difficult to overproduce and malleable to mint into coins, bars, and bricks. Civilizations have consistently used gold as a material value. Perhaps modern societies would be well served by looking at the properties of gold to see why it has served as money for millennia, especially when someone's wealth could disappear in a click. Interesting. And I found this article interesting as well, how technology can democratize gold investment. By making gold more accessible and shifting society to a save in gold mentality, we are enabling a broader society to enjoy the benefits of gold investment. Now, I just wanted to share those couple of little articles and highlights from those articles with you. Now, John Paulson, many people now are just seeing inflation, and quite large inflation, some hyperinflation. Now, gold and silver are obvious plays at maintaining purchasing power in an inflationary, stagflationary, or even hyperinflationary environment. Now, I don't invest 100% in any asset class. I don't. I own a lot of gold, a lot of silver, physical. I own a lot of gold and silver miners, a lot of gold and silver explorers, some other commodity producers and explorers as well. Still got a little bit of real estate. But I also am sitting on a portion of my portfolio in US dollars. So, you know, and then I've got private businesses as well. And these are the type of assets, and obviously I trade options and whatnot, both on the sell side and the buy side. So I feel that I've got a diversified portfolio for the macro outlook, which is an inflationary environment. But I'm not 100% in gold or 100% in silver. I think that's ludicrous. That's mad. That's not what I do. But I think saving a portion of your income or a portion of your assets in physical gold in particular would be a wise move. And that's not me saying it. That's, look, we've got billionaires who have never invested in gold now buying gold. And when the flood of, you know, savings starts pouring into gold and silver, you know, they're such small markets compared to, you know, the bond market, fixed income, and stocks, then we're going to see that parabolic move that John talks about. And I absolutely agree with that and believe that, because I believe we are in that macro environment, which is an inflationary one. So anyway, that's my opinion, not financial advice. What do you guys think? Love to see your thoughts and opinions in the comments below. If you like the video, please hit that like button. If you haven't yet subscribed, do so and hit that notification bell. Anyway, take care, guys, and I'll see you again on another episode of Finance Uncut.